I'm Ryan Iverson, and this is the Investor Breakout Weekly Insight. Let's talk about what happened this week. Something just broke in the bond market, and it's going to hit your mortgage, your portfolio, and your borrowing costs before most people realize what happened. US Treasury yields are exploding higher. The 30-year bond just pushed above 5% for the first time since 2007. The 10-year is sitting near levels we have not seen in over a year. And the reason is simple. Investors are losing confidence that inflation is coming down anytime soon. Oil prices are still elevated because of the Iran conflict. Governments continue running massive deficits, and markets are suddenly realizing central banks may not be cutting rates after all. That is a huge shift. Just months ago, traders were betting on multiple rate cuts. Now some are pricing in the possibility of rate hikes again. And when bond yields spike this aggressively, things start to break. Mortgage rates move higher. Corporate borrowing gets more expensive. Growth stocks come under pressure. Even Canada is getting dragged into it. Canadian bond yields have surged alongside the US, putting more pressure on fixed mortgage rates and adding another headwind for the housing market. What makes this move different is the tone. This is no longer a calm market expecting a soft landing. This is a bond market forcing investors to confront the possibility that inflation, the dreaded higher for longer case, could happen. The Strait of Hormuz is quickly becoming one of the most important pressure points in global markets. Roughly 20% of the world's oil moves through that narrow shipping route. But it's not just oil. About 30% of global nitrogen fertilizer supply also flows through that region. And now, as conflict in the Middle East disrupts shipping and drives energy prices higher, the ripple effects are spreading far beyond energy markets. One of the industries starting to feel it most, agriculture. Canadian farmers are heading into spring seeding, with diesel prices up more than 50% year over year, while nitrogen fertilizer prices have jumped roughly 40%. That matters because crops like canola and corn are heavily fertilizer dependent, and farmers are already talking about planting fewer acres next year if costs stay elevated. This is how macro shocks move through the economy. First oil spikes, then freight costs rise, then fertilizer, fuel, transportation, and food supply chains all start tightening. And eventually, consumers feel it too. Not necessarily because farmers can charge more. They sell into global commodity markets and take the market price, but because everything around the system becomes more expensive to move. This is why markets are watching the Strait of Hormuz so closely. This isn't just affecting oil markets, this is becoming an inflation story across multiple industries. I'm Ryan Iverson, and we'll see you next week.